Hi, my name is Dr. Annette Moultrie, and this is Accounting 101. So, let's see what we will teach in this video. But before we proceed with the video, I need you to click on the subscribe button. Click on the thumbs up button below. Click on the notification bell so you'll be notified of upcoming videos. Also, please share this video. Okay, so we're starting this video with Chapter 3. And Chapter 3 involves the adjusting process. The adjusting process. The learning objectives for Chapter 3 are differentiate between what exactly is cash basis accounting and accrual based accounting. What are the differences between cash basis and accrual basis? To define and apply the time period concept, we're going to talk about revenue recognition and matching principles. 3, explain the purpose of and journalize and post adjusting entries. 4, explain the purpose of and prepare an adjusted trial balance. And 5, identify the impact. What is the impact of the adjusting entries on financial statements? 6, explain the purpose of a worksheet. What is the purpose of a worksheet, and also use it to prepare adjusting entries and the adjusted trial balance. 6, explain the purpose of a worksheet and use it to prepare adjusting entries and the adjusted trial balance. And finally, 7, understand the alternative treatments of recording deferred expenses and deferred revenues. I believe in this video, we will only cover learning objectives 1 and 2. So beginning with the first one, differentiate between cash basis accounting and accrual basis accounting. So what is the difference between cash basis accounting and accrual basis accounting? There are 2 ways to record transaction. One is using the cash basis accounting, and of course the other is accrual basis accounting. With the cash basis accounting, you would record transactions based on the receipt or the payment of cash. Under the cash basis accounting, revenues are recorded only when cash is received or payment is received, and also only when expenses are recorded when the payments are made. With the accrual basis accounting, you would record the effect of each transaction as it occurs. So in other words, when revenues are earned and when expenses are incurred. Therefore, revenue is recognized when the service is performed, not when the payment is received, as the receipt of cash may occur at a later date. The accrual basis accounting is required by GAAP. The cash basis accounting is not allowed under GAAP. So here you see the differences between cash basis accounting and accrual basis accounting. With the cash basis accounting, it's an easier method to follow. It requires less knowledge of accounting concepts and principles. However, with accrual basis accounting, it provides a better picture of the business revenues and expenses. Here's an example that we're going to discuss. On May 1st, the company Smart Touch Learning, they paid $1,200 for insurance, but that's $1,200 is for the next 6 months. Okay, so that would be $200 per month. Now, the prepayment of the insurance, it represents coverage for the months of May through October. Under the cash basis method, the company Smart Touch Learning would record the entire $1,200 on May 1st. And this is because the cash basis method records an expense when cash is paid. But with the accrual basis accounting, the company will have to prorate the expense. So in other words, the company Smart Touch Learning would record $200 expense each month from May through October. So that's $200 each month. However, you see that with the cash basis accounting and the accrual basis accounting, the total expenses will be the same amount at the end. Here's another example. Suppose that on May 30th, the company Smart Touch Learning, they received $600 for services to be performed for the next 6 months, May through October. Under the cash basis method, the company would record that $600 of revenue when the cash is received on April 30th. However, the accrual basis method requires the revenue to be recorded only when it is earned. So Smart Touch Learning would record $100 of revenue each month for the next 6 months. Okay, so under both methods, the cash basis and the accrual basis, the total amount of revenue and expense recorded on October 31st, it would be the same, the total amount. Okay, the total amount of revenues and the total amount of expenses recorded will be the same amount on October 30th. However, the major difference between the cash basis accounting system and the accrual basis accounting system is the timing of recording the revenue or expense. So that's learning objective 1. Now we're getting to learning objective 2. Define and apply the time method concept. We're going to talk about revenue recognition and matching principles. What exactly are they? So the first one we're going to talk about is the time period concept. The time period concept simply states that a business activities can be sliced into small time segments such as months, quarters, or years. Now, typically, a company's fiscal year spans a period of 12 months. We know that. A calendar year is a fiscal year that begins on January 1st and ends on December 31st. That's a calendar year. Now, many companies begin their fiscal year at the beginning of a quarter following a slow period. For example, retail companies such as Walmart and JCPenney, they may have a fiscal year from February 1st to January 31st. Why? Because usually January is a slow month for the companies because it follows the holiday season. The revenue recognition principle, it tells accountants when to record a revenue and requires companies to follow 5-step process. There's a 5-step process in the revenue recognition principle. And the first step is identify the contract with the customer. What is a contract? A contract is merely an agreement between two or more parties that creates enforceable rights and obligations. Step 2, identify the performance obligations in the contract. So what is a performance obligation? Well, it is a contractual promise with a customer to transfer a distinct good or service. A contract might have multiple performance obligations. For example, AT&T. AT&T provides a new phone to customers. Customers will sign a 2-year service agreement. So with the phone and the service agreement, it represents two distinct performance obligations. Again, the cellular service agreement and the new phone. That's identifying the performance obligation. Step 3, determine the transaction price. The transaction price is the amount that the entity expects to be entitled to as a result of transferring the goods or the service or services to the customer. Step 4, allocate the transaction price to the performance obligation in the contract. Now, if a transaction has multiple performance obligations, the transaction price will need to be allocated among the different performance obligations. And step 5, recognize revenue when or as the entity satisfies each performance obligation. Now, the business will recognize revenue when or as it satisfies each performance obligation by transferring a good or transferring a service to a customer. Okay? A good or service is considered transferred when the customer obtains control of the good or obtains control of the service. The amount of revenue recognized is the amount allocated to the satisfied performance obligation. That's the revenue recognition principle. There are 5 steps. Now we're going to go into the matching principle. The matching principle, sometimes it's called the expense recognition principle. It guides accounting for expenses and also ensures that all expenses are recorded when they are incurred during the period and expenses are matched against the revenues of the period. Now, to match expenses against revenues means to subtract expenses incurred during one month from revenues earned during that same month. So the goal is to compute an accurate net income or net loss for that time period. Now, some expenses are easily linked to revenues. For example, Smart Touch Learning, they pay a commission to the employee who sells the e-learning company's services. Now, the commission expense is directly related to the e-learning company's revenues earned, right? However, there are some expenses that are not easily to link to revenues. For example, Smart Touch Learning's monthly rent expense occurs regardless of the revenues earned that month. So this video, we covered 2 objectives of Chapter 3. We stated that the cash basis accounting records transaction based upon the receipt or payment of cash. And we know under the cash basis, revenues are recorded only when cash received, and expenses are recorded only when cash payments are made. With the accrual basis accounting, it records the effect of each transaction as it occurs. So that's when revenues are earned and when expenses are incurred. We also talked about the time period concept. revenue recognition, and matching principles. So this is the end of learning objectives 1 and 2. So in our next video, we will start with learning objective 3.3, which explain the purpose of and journalize post-adjusting entries. So stay tuned for the next video. We're continuing our discussion of Chapter 2, the adjusting process. Thank you. Thank you for watching. And please, if you haven't already, please click the subscribe button below.